Okay, good evening, everyone. Welcome to the Florida Alternative Investment Association Global Macro Perspective 2016. My name is Rainford Knight. I'm a board member of FLIA. Just by way of background, the organization was started, Florida Alternative Investment Association, started back in 2007. For those of you who are not familiar, as the South Florida Hedge Fund Managers Association by Mike Corselli. And over time, the idea, Mike was frustrated with not having a hedge fund community here in South Florida, so he started to have these dinners where he'd invite a few managers that are here on Grable to kind of sort of come out and talk about markets and events that were currently happening in the hedge fund industry. And so that grew into what is now a nonprofit organization called the Florida Alternative Investment Association. So it's been around for quite some time. Before I continue, I'd like to thank our host, Stephen Ackerman, as well as our sponsor, KPMG, for supporting us in this event. And we hope to continue having these events next year. And later I'll introduce Steve Malloy, our Executive Director, and give you some information about our upcoming events. Just by way of background, the idea of FLIA, in terms of what the organization stands for, we have a mission and vision that we set out back in 2010. One was to build a hedge fund community here in South Florida so that managers that were here had a place to go to sort of exchange ideas and communicate with managers that are new to the area. Second was brand building, where helping the state of Florida become more than just a vacation spot, letting the world know that there are actually people running hedge funds here in South Florida, not everybody's retired playing shuffleboard. That was, and it's a brand issue, but that was one of the motivating factors in terms of trying to build a hedge fund association here in South Florida. Third, and for managers, it's important, the idea of capital attraction, being able to expose managers in South Florida, and Florida in general, to allocators willing to invest in Florida managers. And to this end, one of the initiatives the organization took on in 2010 was to work with the State Board of Administration, the fourth largest pension fund in the U.S., to increase the allocations to hedge fund, which resulted to a $15 billion pool of capital available for allocation to hedge fund managers. And the fourth initiative or mission, vision, objective was this idea of business attraction. Not only to attract hedge funds to Florida, but also to attract other non-financial firms to build out a community. And I don't know if you guys have seen the Preqin study, but according to Preqin, Florida is now one of the major states in terms of allocation. Miami institutional investors allocate approximately $65 million to hedge funds, making Miami one of the fastest growing areas for allocation in the U.S. Second to the North American average of 16% in terms of percentage of institutional assets. So Florida is now a place where you can actually run a hedge fund business, right, which is an amazing thing considering where we were in 2007. Now I'd like to introduce Steve Malloy, the Executive Director of FLIA, to kind of give you an idea of what's upcoming and some of the metrics around the organization. Steve?
Thanks, Ray. I'll be short as well here. First of all, thank you very much for coming, and secondly, thank you, Mike, for putting this together. This is something that took a lot of time and a lot of work putting together, and nobody knows how much it was except for me, because I was sort of watching you do it the whole time. Unfortunately, not helping as much as I wished I could. But thank you very much for everyone for coming to this event. I think recently what you've seen is FLIA has put together more social cocktails and meetups and things like that. And in the past, FLIA has done some great conferences, and that's what we're going to get back to, things like this, where we can get such a good crowd of interesting people where you want to hear from these speakers, which is, as you'll see, it's a great panel that we have here. FLIA is also co-hosting the Alpha Hedge East Conference in Palm Beach coming up in the beginning of 2016, and we're supporting a lot of the other conferences in the Florida area, which you'll see. If you're not signed up, I know this is sort of basic, but if you're not signed up, please get on the list, please follow. If you'd like to join the group, we'd appreciate the support. If there's any other way you can support, such as Ackerman, this is great what they've done here in the officer space. It's beautiful and we really appreciate it. Once again, I'd like to thank KPMG, Michael Cross is the man behind KPMG who really helps us out year after year, and we really appreciate that, and to all the other support. Right now, I'd like to introduce Jonathan Honor from Ackerman. Thank you very much.
Good evening. Thank you all for coming. I'm going to be very brief. Just wanted to thank Michael for allowing us the opportunity to host all of you. And just for those of you who don't know Aikman, we're a full-service commercial law firm with the largest law firm in the state of Florida. We have a very strong focus on middle market, merger and acquisition, and investment work for private equity firms, family offices, and institutional investors. So we welcome the opportunity to meet with all of you tonight. Thanks. See you.
Thank you, Jonathan. Right now, I'd like to introduce Thomas Trujillo from KPMG, who's going to be the moderator of the panel.
Let's see if this microphone works. Can you all hear me? No. No? We tried to work on this, and I'm not sure. Is there any way we can turn it up? Should I use that one? Oh well. I'll try to speak loudly. And you can come here to hear me speak anyways. So we've got a great panel here for you. Thank you again for the invitation. Appreciate the opportunity to moderate the panel. Thank you to Ackerman for hosting. Actually, I'm going to bring this back over to you guys because you need it. Just a little background on me. I'm a partner with KPMG, an audit partner in the asset management practice based in Dallas. Work with Michael Cross. And again, just a pleasure to be here. I'm going to let our panel take a few minutes and introduce themselves and kind of tell you what their background is and what their specialty is. And we'll start off with Peter Halloran.
For the purposes of this conversation, I can speak to emerging markets as well as oil and gas. I am the CEO of Ferris Financial Group, which is an investment firm set up in the 1990s to focus on emerging markets. Our initial capital came from Soros, and we expanded dramatically after that. We ran several award-winning hedge funds along the way. During the 2008 crisis, we never gated, we never reset high water marks. We provided liquidity all throughout the crisis, so we were pretty battle tested as a manager. Going back about 6-7 years ago, we rotated toward U.S. oil and gas and started to focus more and more on that. A couple of years ago, we launched an investment arm called Titanium Exploration Partners, which is Dallas-based. It's got a full team of engineers, land managers, and financial reporting capabilities. We have interest at this point in over 100 wells. We've got over 1,000 barrels a day of production, and it's going actually quite well despite the headline news on the commodity price change. Our mandate and our strategies are typically about development drilling and high IRR type investments. However, given the dramatic sell-off in oil prices, you've had a corresponding sell-off in the value of well bores and producing assets. And in this environment, we look at that as a new opportunity, so we're actually rolling out a different sort of investment mandate which focuses on producing assets where your yield is high single digit, your IRR will be somewhere in the low double digit, and that's using today's pricing environment. If you believe oil prices are going to trade at $30 and stay there for the next 10 years, you'll still break even with what it is we're planning to do. If you think oil is going to trade through 65 over the next couple of years, then your IRR will bump up north of 20. So there's a lot going on in U.S. oil and gas. It's part of why we've downsized our emerging markets activities, and there's a lot of people this evening that can talk to emerging markets, but that's what we do. Thank you very much.
Great. Thanks, good evening. My name is Shannon Morton. Mike, thank you very much for the invitation. Pleasure to be here. I have been in the industry for over 20 years. Ironically, Luis LeBoy here to my left and I used to run in the same circles of Green Wall Street 20-somethings back in the day. So indeed, it is a very small world that we're sitting here on the panel together tonight. I spent the majority of my career as a portfolio manager at AIM Investments, which is now Invesco, and then at AllianceBernstein. I helped launch an outsourced CIO business owned by TIAA-CREF before joining BlackRock as part of the global strategy team in 2013. We were also asked to kind of give some high-level thoughts and maybe a short summary of views to kind of kick off the conversation tonight. So I think it goes without saying that investors are predictably very nervous today. In fact, some investors are even paralyzed with the bull market stretching to reach its 7th birthday in March, and with the global economy arguably long in the tooth. We actually think it still has legs to run in 2016, but I think agreeably it's in the late stages. You know, there are a few dominant themes that we think are driving the capital markets today. Certainly monetary policy has been the dominant driver of investment returns for years now, and with the liquidity tide turning, we actually believe that the valuation, the credit, and the business cycle are going to become increasingly important drivers of capital market returns going into 2016. Monetary policy is also a key theme. So, as we all know, with the Fed nearing policy normalization and with the pending Fed rate hike over 80% of the market now, of course, thinks that's going to happen in a couple of weeks at the next FOMC meeting. The Fed is preparing to raise interest rates while the rest of the world is still firmly in easing mode. So remember, 35 of the 75 largest economies have eased in the last year, and this divergence, not only in monetary policy but also in economic growth, has profound implications for rates, inflation, currencies, commodity prices, and even corporate profitability. You know, I think looking at the U.S. In a nutshell and zooming in on the U.S., while growth is nothing to brag about, and surely looking at the ISM numbers last night, which actually lend concerns to a manufacturing recession, we actually don't believe we're on the verge of a recession here in the U.S. We think we're going to trend along with tepid growth. It will continue to be a mixed bag, but we think it's stable and it's solid enough for the Fed to move off of zero interest rate policy, and arguably we think that they perhaps even missed their window to do it earlier, and that moving off of zero would be a good thing. Outside the U.S., as we know, there's really been a perfect storm of events that global markets are contending with. From global growth concerns to global deflationary fears, a pending Fed rate hike, plunging commodity prices, extended valuations, deteriorating credit conditions, and that's just to name a few. And now, of course, the fears of increasing geopolitical concerns, which we also agree will come to the forefront in 2016. All that being said, the bottom line is we think that the next year and even the next few years may actually introduce a new environment to us as investors and to clients, one that we're not particularly used to. A new regime of much higher volatility, more muted returns across most equity markets, and little to no price appreciation in bonds. So we would argue for much greater selectivity, greater discretion when it comes to allocating assets going forward. I'll just wrap up with the good news. I promise there is good news, and that is that for those that are concerned about a 2008 redux, we actually believe, to quote the great Yogi Berra, that this is not deja vu all over again, that global and economic conditions are in fact very different today than they were in 2008, and global financial conditions will remain easy going into 2016. So while we would argue for caution and selectivity, we do believe that there are pockets of opportunity, now pockets of value reestablished in the market, but certainly risks to avoid, which we can talk more about. Thanks.
Hi, good evening. Thank you all for joining us today, and thank Playa for clearly they're a full-service association. Not only do we get the chance to speak, but we get old friends get to meet again unexpectedly. I work with RWC Partners in our Emerging and Frontier Markets team. We're the team that was formerly part of Everest Capital until probably about 7, 8, 9 months ago. I focused on emerging and frontier markets for the greater part of 20 years or so, and spent 13 of that with the same investment team at Everest Capital, now RWC. Essentially, we focus on, our investment process is one where we focus on both the top-down thematic approach, and we mix that with a fundamental bottom-up analysis, and the goal of obviously finding the highest return opportunities. We take a global perspective. We invested in over 120 countries globally. We were calculating the other day, we actually have to do this for the SEC. We're going to make the statement where you know how many meetings you have a year. We meet with over 1,000 managements in their countries every year as part of our team, plus conferences and what we do. RWC runs, the firm is actually based in London. It's about 40% owned by Schroders. We run about $12 billion. The emerging and frontier markets team are about $1.5 billion of that. And essentially we have a couple products. We have a long-only diversified emerging market fund. Same thing, long-only diversified frontier markets product. We have a long-short frontier markets product and an Asia long-short product. And essentially they're all run the same, both at a reasonable price. The way we're structured is we have one investment team that thinks globally. We all interact as one team, and then the PMs pick the best ideas of what the analyst team brings forth and what comes from our thematic research. And you know, I think kind of picking up on what Shannon was saying, you know, it's fair to say emerging markets has essentially been in a bear market for about 7 years, at best going sideways during that time. And you know, with the adjustments that we've seen with the strength of the dollar, basically since 2011, really accelerating since 2013, we've seen what we're focused on is looking at which countries have made adjustments. And I'll talk a little bit more about it as we progress through the night. But we essentially just grab a CRIC model. And a CRIC model is just really crisis, response, improvement, complacency. And we basically create a CRIC clock by which we look at all the countries across emerging and frontier markets to see where they are on this clock, to help guide us to where the best opportunities are at any given point in time on the top down. And despite what we've seen in emerging markets for so many years, we continue to see some really great opportunities. Same thing with China. We can talk about China, whether it's up, down, slowing, accelerating, whatnot, but it is a multi-trillion-dollar economy with 1 billion people and a very, very deep market, and there's a lot of opportunities in there. And that's what we focus on, is kind of sifting through those. And one guy at work likes to say, we're looking for the elephants. But anyway, I'll stop there. Thank you again for joining us, and thank you for the invitation.
Sure. My name's Daryl Jones. I'm the Director of Research at Hedgeye Risk Management. Hedgeye was a company I founded about 8 years ago with some partners. I think I'm the sole representative of the sell side here. And our idea 8 years ago was really to reinvent how Wall Street created, distributed, and sold research. Our business is creating investment ideas for our clients. That's all we do. So either we're right or we don't get paid. Business is pretty simple. We've grown the business pretty dramatically over the last 8 years. Now have about 35 people on our research team, which is probably equivalent to any large fund. Our clients collectively manage over $1 trillion, so we have some influence in the marketplace. In terms of what I can focus on tonight, obviously the U.S. economy is a big focus for us. We think the expansion is very much long in the tooth. One of our key themes is what we call super late cycle. If you look back at any cycle going back to the 1930s, the median cycle is about 50 months long. We're now at the 77th month. If you look at what the Fed's projecting in terms of rate height increases through 2018, you would have the longest expansion in history. We obviously don't think that's going to happen. And we do think that the recession has gone from not being probable to being back on the table heading into 2016 and 2017. So with that, I guess we can open it up for a Q&A.
Well, my name's Michael Corselli, and thank you all for coming. Art Basel. It's the best place I feel to be at this time of the year, and it's my favorite time as somebody who's lived here in Miami for 20 years. I'm the founder and chairman of the Florida Alternative Investment Association. I also run a long-short equity fund called Alexander Alternative Capital. We start with global macro, looking top down to develop a global macro view, and then become more specific inside of themes. Once we have the themes, we use bottom-up fundamental research and analysis to express these macroeconomic themes. The book we run is about 15 long stocks, five short stocks, a highly concentrated portfolio. We use systematic risk management to limit the drawdowns in the portfolio, and it's just a pleasure to be here. Some of the things that we've been really focused on is oil, technology, and financials. We tend to put our time into those three places, so I'm happy to speak on any of that.
This one. But we want to make sure that this panel is also interactive. So at any time during the program, feel free to ask questions and pick these 5 great minds up here as to the global macro trends that they're seeing across their space. But I think just to kind of kick off, ladies first, I'm gonna go straight to you, Shannon. But you had mentioned, in your introduction, talking about Fed policy and getting ready to watch the Fed most likely increase rates here at the next meeting. Looking at that, I mean, how are you all approaching, just taking that into consideration with your investment portfolio and what you guys are seeing in-house at BlackRock?
Sure. The Fed policy, and as the Fed nears normalization, again, we have long been proponents of the Fed moving even earlier this year. We felt that the U.S. economy and the labor markets were finally balanced enough for the Fed to move from zero interest rate policy. We were very vocal about this. Of course, as the year wore on, the Fed was more clearly concerned about themes and concerns outside of their dual mandate of full employment and stable prices. That being said, they became much more concerned about the economic implications of higher U.S. interest rates and, of course, the impact on global financial markets. But now we think the Fed, and finally the market do agree. There has long been a very big disconnect, as we all know, between the Fed guidance and what the market has been pricing in, and now finally they are nearing a consensus, and we think the Fed will move in December. We actually think that the market might be pricing in too conservative of a Fed policy, next year only pricing in 2 moves. We actually think that might be too little. The tail risk there, we were just having conversations earlier tonight, is that it actually may be too much, and if things go the opposite way, the Fed might not move as much as expected. We actually do think that if the economy continues on trend, that the Fed does have the ability to move. But this divergence in central bank policy and economic policy has, as I mentioned earlier, really meaningful implications. The first of which is the demand for U.S. dollar-based assets. So as U.S. interest rates rise, even though short-term rates will begin that rise, long-term rates will arguably still stay structurally low. They are still more appetizing than global government rates around the world. So we still think that demand for U.S. dollar-based assets and higher yield will cap long-term interest rates and strengthen the U.S. dollar. So while we have seen the euro have a very big run, as well as the Japanese yen, we think that there will continue to be divergence between those currencies. And remember, as the U.S. dollar continues to strengthen from here, that also has implications, as it will put downward pressure on not just U.S. multinational earnings and corporate profitability, but commodity prices, as well as inflation, which of course has been stubbornly low, and the fall in oil prices has also impacted long-term inflation expectations, which is a very big concern for the Fed, given our and non-U.S. markets' efforts to try and reinflate our economies. So I think, big picture, the Fed should move. There will be implications in terms of market reaction. Interestingly, initial Fed funds rate hikes by the Fed, they typically cause more volatility. However, the good news is they don't cause bear markets, and they don't stop bull markets. But what is even more interesting is that the US dollar actually declines before it increases. So in the months following an initial rate hike, don't be surprised if we actually do see the dollar weaken before it starts to trend upwards again over the next several months.
Yeah, I think
Wanna add
one very good
comments?
point in the U.S. and monetary policy globally, and I think an unintended, maybe potentially severe consequence of the Fed raising rates when everybody else is lowering rates globally is the dollar ultimately could be a lot more stronger than people expect. That could be the unintended consequence, where we have a very, very strong dollar, and again, that's really bad for U.S. corporate profits, which obviously impacts the S&P 500. Corporate profits go down, the S&P 500 is not going to go up, and then the other unintended consequence of the strong dollar is weak oil prices, which obviously are deflationary. So I do think this divergence is something that really investors are going to be and going to need to be focused on heading into 2016.
Any other comments from Michael, Lewis, or Peter? Because I think, go ahead.
I mean, I tend to agree with Shannon that you're going to see the dollar, I expect the dollar to weaken first as part of this move.